When it comes to cryptocurrency investment, there isn't much discussion about managing risk, and yet many of the principles that are used in classical asset allocation can equally be used to manage the risk for cryptocurrencies. So in this video, we'll look at some of those methods for reducing your risk. And if you do want to learn more about investing, both in cryptocurrency, but also for traditional assets, then a great way to do that is as part of our Patreon community. In order to do that, just look at the link in the description and the link next to me to learn more. So now let's look at cryptocurrency diversification in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So why would we consider diversifying cryptocurrency in the first place? This is looking at the return of cryptocurrencies over a 1-month period in 2021 from April to May. And you can see that some of the returns have been incredibly good. So for example, Dogecoin is up over 700% over that period of time. But if we look at the bottom of the graph, we can see that Bitcoin has fallen by almost a quarter over the same period. So it's clearly the case that we see massive fluctuations in the value of cryptocurrency, and it's just part of the territory if you invest in that asset class. Now, unfortunately, we can't predict which cryptocurrency is going to really rally in the next month or the next year, and so we might have to consider spreading our investments across multiple cryptocurrencies. So one of the reasons why you might diversify a cryptocurrency portfolio is because you'd capture these outsized returns for some of the cryptocurrencies, and also protect yourself from the sharp falls in other cryptocurrencies. Now, many people think that the big sell-off in Bitcoin was triggered by this tweet from Elon Musk, where he said that Tesla would no longer accept Bitcoin as a payment for its cars. And the reason given for this by Elon is that Bitcoin uses a lot of non-renewable energy in its proof of work algorithm. Now, that may or may not be true, but what is clear is that one tweet from one man can create a massive sell-off in just one cryptocurrency. And that's another reason why you might want to diversify. As if that wasn't bad enough, 4 days later, there was a tweet from Mr. Whale, who's Crypto Whale on Twitter, who said that Tesla had already sold all of its Bitcoin holdings. But at this point, it seemed as if Elon was confirming that that was the case. Later, he denied it. If we look at the prices of the two largest cryptocurrencies, that's Ethereum here at the top and Bitcoin down at the bottom, what I've done here is I've marked the dates of those two tweets as these vertical dashed red lines. And it looks like that first tweet reversed the momentum in Ethereum, which up to that point had had a very strong rally. And for Bitcoin, which had pretty much been trading sideways for some period of time, that first tweet started to put it into reverse. And so far, at least, that sell-off hasn't stopped. In contrast, if we look at another cryptocurrency called Dogecoin, I've marked the tweets from Elon which are positive about Dogecoin in blue. You can see that the first tweet didn't have a huge effect on the price at all. Maybe there was a bit of a blip after that. But then what you start to see is that the tweets about Doge come thick and fast. And in fact, recently there have been cluster after cluster of Doge tweets from Elon. And in fact, the price rise of Dogecoin was so remarkable over this period that I've had to use a logarithmic scale for the y-axis. And you can understand why some people think of Elon Musk as the Doge father. But just as Elon giveth with one hand, he taketh away with the other. So let's just hope he doesn't start taking away from this cryptocurrency. But that's why it's probably a good idea to back multiple currencies. Because what you don't want to happen is for a billionaire's tweet to suddenly give you an incredibly bad return. Now, naturally, there was a lot of anger about Elon's tweets, and Bitcoin Archive tweeted about it, and Elon actually replied and said that Tesla hadn't sold any Bitcoin, but that wasn't enough to stop the sell-off continuing. Now, the flip side of return is risk. Usually to get an outsized return, you have to be willing to put your capital at greater risk. How do we measure risk? Well, one measure is called volatility. You can think of it as the price wiggliness, or mathematically, it's a typical percentage annual price move. Now, for a typical stock index, we'd expect that to be around 15 to 20% every year. But what I've shown here is that 1 month period in 2021 for a wide variety of cryptocurrencies. And here at the top, you can see Dogecoin is the most volatile of all of them, with a volatility of more than 300%. That's over 10 times what you'd expect if you invested in an equity index. If we look further down the graph at the largest two cryptocurrencies, that's Bitcoin and Ethereum, the volatilities are much lower, but still very high. So for Bitcoin, it's about 62%, and for Ethereum, about 85%. Now, while the returns were incredibly high for a wide range of cryptocurrencies, nobody cared about risk. But the problem is that eventually markets turn against you. And that's clearly happened for Bitcoin. And when you have a high volatility investment, it tends to fall more. Now, the right thing to do when there's a huge fall in price is to buy more of an asset. If you believe in it, that would make sense because then the asset is on sale. But what usually happens is that people panic and they sell, and then they crystallize a loss. Now, it's certainly not true that all cryptocurrencies are extremely volatile. There are some stable coins, which you can see here at the bottom. So that would be Tether and USD coin, where the volatility is very low. Because these two are pegged to the value of the dollar, they have almost zero volatility. It's just 1%. And if we look at Pax Gold, which is linked to the value of gold, the volatility is that of gold, which is about 19% over this period. So the simplest way to reduce your cryptocurrency volatility is to buy some of these stable coins because they keep their value when other cryptocurrencies crash. Of course, that'll be a massive drag on your returns, so you don't want to put too much into these stable coins. But if you do want to reduce volatility, that's the simplest way to do it. Put some percentage of your portfolio into something which has a lower vol. Now, some people say that as cryptocurrencies mature, their volatility should fall. So what I've done in this top plot is to look at the volatility of Bitcoin over a 90-day window. And then we gradually slide that 90-day window from left to right and look at how volatility has varied. The average volatility over that period is the dashed black line, and you can see that it's been oscillating above and below that, but it hasn't really fallen much. It looks like for Ethereum, there certainly has been a fall in the volatility over that period, but again, it seems to have stabilized at a fairly high level. So just waiting for cryptocurrency to somehow mature and hoping that the volatility will go away is just not going to happen anytime soon. If we want to diversify stocks, we'd usually invest in bonds because they have a negative correlation with equity most of the time, and that acts to reduce the volatility of your portfolio. So what's the cryptocurrency equivalent of bonds? Well, as we already saw, stable coins whose value is linked to the value of the dollar are very low volatility and very low risk. And here's a description of USD coin on the circle.com website. And one of the ideas behind USD coin is that it can be exchanged very rapidly, but also very cheaply. Now, I think in the US, where the banking system is more fragmented, it's much more difficult to transfer money cheaply and quickly. But in Europe, certainly I think the case for USD coin and its equivalents is much weaker, certainly as a payment system. But in the US, USD coin, which has a ticker USDC, is very popular and it's growing in popularity all the time. Here's a comment from a member of our community on PensionCraft on our Slack channel who's talking about another reason why you might want to use stablecoin, which is the very high fees that you have to pay to move money off an exchange into your bank account. He says you pay fees to convert between crypto and fiat, that's your normal bank account money, but you don't pay such a high fee to convert from crypto to stablecoins. So it's a way of converting your cryptocurrency to cash, but with lower fees. And if you did want access to our Slack channel to ask your own questions about investment, then you can do that by becoming a member. So how stable are these stablecoins? Over this entire period, there was a move of less than 0.8% up or down. So both of these stablecoins, Tether and USD coin, did what they were supposed to. They kept their value close to 100 throughout this entire period. Now, another alternative is to link the value of our cryptocurrency to gold. And that's exactly the idea behind Pax Gold. And if we look over the last 6 months, you can see that it has tracked the value of gold pretty closely. So if you are bullish on gold, this could be an alternative to standard stablecoins to diversify your portfolio. Now, a standard way of reducing the risk of an equity portfolio is to buy an off-the-shelf portfolio weighted by the size of the stock. And that size is called market capitalization. So for example, if you buy an S&P 500 tracker, what you'd actually be buying is a portfolio of the biggest stocks in America weighted by the size of each stock. And the size of the stock, or the market capitalization, is simply the number of shares which you can trade multiplied by the share price. Now we can also do that for cryptocurrency. So we'd look at this column on the right here, which is the supply of each coin, which in the case of Bitcoin is just under 19 million at the moment, and we'd multiply by the price. And that would give us a market capitalization of just over £600 billion. And what I've done here is sort the table by market capitalization. So if we were to do the same thing for cryptocurrency, you could just buy in proportional to these market caps. So if your portfolio just had two cryptocurrencies, Bitcoin and Ethereum, you'd hold them roughly in the ratio of 3-1, because that's the ratio of the market capitalization. And in fact, the index provider, Standard & Poor's, has already created a cryptocurrency megacap index which does exactly that. And this cryptocurrency megacap index which they've created contains just two cryptocurrencies. That's Bitcoin and Ethereum. And if we plot the volatility of this index, we'd notice that it's slightly lower than either Bitcoin or Ethereum, because it is to some extent diversified. But it turns out that it's very easy to do a lot better than that if we want to reduce the risk. And the way we do that is to use something called portfolio optimization. So let's start off in this top left-hand panel. This portfolio is very special because it combines the assets inside it to minimize the risk of the portfolio. In fact, that's not exactly true because it tried to put far too much money into PAXG, the gold tracking stablecoin. So I had to constrain it to only put in 40%. But notice how the second largest weight was in Bitcoin, which has an allocation of 29%. Now the reason for that is that Bitcoin had one of the lowest volatilities of all of these assets. And again, I had to exclude the stable coins because it would have just put far too much money into those. What's also interesting is that it didn't put too much into Ethereum, only about 6%, because what this also considers is a correlation between cryptocurrencies. So let's say we had two cryptocurrencies that were perfectly correlated. What this algorithm would do would be to just go for one or the other, because buying both would just double up our risk. Whereas if we have two cryptocurrencies where one zigs when the other one zags, that reduces our overall volatility. And I suspect why it has such a large allocation in Polkadot is because that has a low correlation with the assets which are largest in the portfolio. Now remember that this only works in a backward-looking way. What it assumes, incorrectly of course, is that the correlations will be the same in the future as they were in the past. So this won't be perfect, but it will come up with a low-risk portfolio. Whereas the minimum risk portfolio only considered risk, the maximum Sharpe portfolio looks at momentum. It will favour assets which have had a very good return in its look-back window. And in our look-back window, remember, Ethereum had very good returns. So that now gets a 19% allocation. But it is risk-adjusted return that maximum Sharpe looks at, because the Sharpe ratio looks at the return you've received over the look-back window, but it divides that by the amount of risk you took to generate the return. And that's why Pax Gold also gets a high allocation of about a third of the portfolio. And just like the minimum volatility portfolio, this will also consider correlation between assets, and it'll deliberately choose allocations where assets are not correlated. So Cardano, which has the ticker ADA, was probably chosen because it had a low correlation to the other assets here, but also it had a fairly good risk-adjusted return. Now the problem with this portfolio is that the weights will change a lot over time. So whereas minimum variance is fairly stable, you wouldn't have to reallocate your portfolio very often, maximum Sharpe will be changing all the time. So that just means more work for you. Risk parity is another way of approaching risk, whereby the weights in your portfolio are such that each of the cryptocurrencies adds an equal amount of risk to your portfolio. Now, low-risk cryptocurrencies will have a higher weight because their marginal contribution to your risk will be smaller. And that's why Pax Gold comes up with the largest weight at 47%. But one of the nice things about risk parity is that, like minimum variance, it's very stable. So the weights this comes up with won't vary much from month to month, so it's less work for you. Now, what we really hate is tail risk, those really large sell-offs that just make us not sleep well at night, particularly for cryptocurrency. So this approach in this panel looks at how we can minimize that loss when we do get those very large drawdowns. But notice how the weights for this strategy are very similar to that minimum volatility portfolio. That's not entirely surprising because both are purely based on the risk of your portfolio and minimizing that risk. Now, there are lots of caveats with this kind of approach, and the biggest one I think is that the future won't resemble the past. But what they do give you is a very good starting point to manage the risk of your portfolio. Now, this is called a risk return plot, and here on the bottom axis you can see risk as measured by volatility, with high risk here on the right and low risk here on the left, and the y-axis is return, so it's low returns here at the bottom of the graph and high returns here at the top. And again, because this is cryptocurrency, we've had to use a logarithmic scale for the y-axis because the returns are so big in some cases. Now, the maximum Sharpe portfolio, which consisted of just 6 cryptocurrencies, actually has a very good return. In fact, it's well over 1,000%. And if we look at the risk of that portfolio, it's lower than that of Bitcoin. That's because it's to the left of Bitcoin on this graph. So we've got that wonderful combination of a risk that's lower than that of Bitcoin, but a return that's significantly higher. Now, all 3 of those risk-based strategies cluster fairly closely together here in the bottom left of the graph. That's the region of low return, but also low risk. Now, the volatility of those portfolios is still pretty high if you compare it with, say, equity. In fact, it's about double the volatility you'd expect with the S&P, for example. But the return for these 3 low-risk portfolios over this 1-year period is still quite good, at over 300%. And if we track the value of $100 invested at the beginning of the period, we can see how much those $100 would be worth at the end of the period. So the maximum Sharpe portfolio would have turned your $100 into over $1,400, and those extremely low-risk portfolios, notice how they're not too wiggly, that's low volatility, would have turned your $100 into something between $470 and $560. Another consideration when investing in equity is valuation. At a time when stocks are very expensive, that tends to reduce the return in the following years. Unfortunately, you can't do that with cryptocurrency because the pricing's driven very much by narrative. Now, there's a well-known article by Plan B, which is called Modeling Bitcoin Value with Scarcity, where the assumption is that having something which is very rare makes it very valuable. This is also called a stock-to-flow model because the x-axis on this graph measures the amount of stuff which is out there. So in this case, it would be the amount of Bitcoin which is already mined. Now, of course, there's a finite amount of Bitcoin which will ever be created, and at a certain point in time, no new Bitcoin will be created at all. But according to this model, the price should then become infinite because the flow will go to 0. The other problem with this model is it assumes demand. If there isn't demand for a good, then it doesn't matter how rare it is, its value will go to 0. And that's particularly true of something like Bitcoin, which doesn't generate any cash flows in future, unlike a stock which generates dividends or a bond which generates coupons. It is literally worth what people are willing to pay for it. And if the demand goes away, the price will simply go to 0. And that's why narrative is so important for cryptocurrency. Now, Dave Portnoy realizes the importance of that narrative, and he's chosen to use his influence in social media to shill a very obscure cryptocurrency called SafeMoon. And that's because he grew very disillusioned with Bitcoin after he suffered losses when Elon turned his back on the cryptocurrency. But I recommend you look at this video. It is absolutely hilarious, particularly when he describes why he chose SafeMoon. Why? I don't know why. It could be a Ponzi scheme. And he says he likes the word moon because that's where I want to go. And if it is a Ponzi scheme, get in on the ground floor. And here he is getting into an elevator on the ground floor of SafeMoon. Now, he got a lot of pushback because people thought SafeMoon wasn't a great cryptocurrency. But he makes the very good point that whoever argues that one fake made-up coin is better than another is clearly somebody who can't be trusted. But more importantly, he'll carry on supporting his coin like it's his child, unlike Elon Musk. So I think a lot of the lessons we can learn from traditional investing carry over really well into cryptocurrency investing, particularly diversification. That way you can build a portfolio where you don't have to lose sleep at night worrying about a billionaire's tweets. So if you do want to support our independence, just click on the icon which is next to me or on the join button beneath this video, and that way you'll get a beautiful icon next to your name on YouTube, which my dog Teddy is modeling here beside me. And that way we'll know that you're one of our supporters, and on a YouTube live we'll answer your question first. And also in the comments to our videos, we'll always try and answer your comment. And as always, thank you for listening.